Well, there's a lot going on clearly in the corporate space at the moment. We haven't even mentioned Woolworths, so that's been another big one out today. Let's go and find out what James Gerrish from Shaw and Partners and author of Market Matters is keeping a close eye on this morning. Great to see you there. Hopefully you're keeping up with everything that's going on at the moment. What's on the radar for you at the moment? Because there is just so much going on.
Yeah, good morning to you guys. Woolies, you made mention of, is the big one today in terms of corporate results. Just looking at their, the headline numbers, they've had a tough period. There's no doubt about that. So they had net profit for the half was down on this time last year, but they have guided to say that the second half will be better than the first half. If that's the case, they're going to beat full year net profit expectations or consensus expectations at the moment. So I'd look at the result and say tough period, no doubt about it, but guidance is okay. The dividend was a slight miss in terms of the market's expectations, but overall it's not a bad result from Woolworths in my view.
James, let's take a step back and look at Hub24. We had a chat with the CEO yesterday after their result. It looked pretty good across the board and their guidance looks great.
Yeah, this is an interesting one. So you think about the sector, so you've got Net Wealth that had pretty significant downgrades in terms of on the back of margin pressure. The same was true over at Premium. Hub24 didn't have that same margin pressure. So their revenue was in line, but their EBITDA was a lot better, and that's because they had better margins than expected. So, when a company is growing their revenue and also expanding their margins, that's a really good sign. So these cost pressures that are being felt across the broader sector haven't been felt as much as Hub, and they've done a better job of managing it. So, we own the stock, we like it, we think it goes higher from here, despite the headwinds that are facing these high valuation growth names at the moment.
What about Dominoes Pizza? It's got a lot of optimism priced into that share price. Did the company deliver today?
Less optimism now, Scuddy, than there was sort of 12 months ago. The stock price has gone from about $165 down to about $100. So today's first half result, it was always going to be a difficult one, and they've delivered a pretty difficult set of numbers. Profit was a slight miss to where the market was expecting. They've come in about 91 million. The market was about 95. That won't be the major focus from a market's point of view. It all comes down to growth. They said that in the first part of this calendar year, same-store sales growth is rocking and rolling at 1.7%. So they do have a longer stated guidance that they want same-store sales to be up between 3 and 6%. So they're below their target, their longer-term targets. They always typically say, we will achieve our longer-term targets. Don't worry about this short-term noise. But it comes down to how much is factored into the price. There's nothing in this result to tell me that we should rip out and buy Dominoes at this point in time. But there has been a lot of negativity in our price into the stock. So not sure what it'll do on this, Scuddy.
And James, Education was another one that you were looking at yesterday. Now you say that you don't earn it, but a turnaround looks like it's on the way. So is it one you're going to be buying?
Yeah, it is. So I think it's a really interesting play down here, Cara. It's sort of trading at $1.27. It is up from sort of that low dollar area, but this is a turnaround play. So they're the second or one of the largest childcare operators in Australia. They've obviously had their challenges over the last 2 years. They've had to recapitalise the balance sheet, but signs yesterday in the result that things are turning around. So from an earnings point of view, and that's being driven by an uptick in occupancy. They reinstated the dividend, and they also launched a share buyback, which sort of shows some confidence in where they're going. So for me, it's cheap. It's got reasonable turnaround prospects, and from an income perspective, it looks a good play here, Cara.
What else is on the eye this morning? Had a lot of gold miners out, REITs as well. Wisetech is another name that's reported. Anything else on the radar?
Yeah, Wisetech was an interesting one, Scuddy. So they've come out this morning, delivered their first half results, but they've also upgraded full year guidance. So the market was sitting for full year EBITDA at 275 million. They've increased their guidance to be now 275 to 295. So the midpoint, it's about a 4% upgrade in terms of EBITDA guidance for Wisetech. So their revenue is in line with expectations. but margins slightly better, so EBITDA takes a tick higher. So watch that on open. That should do all right on the market today. But overall, reporting season has been pretty good. I'm reasonably surprised around how confident companies are to forecast for the full year. So that's a positive sign for mine, Scuddy. So it'll be interesting to see how all of these raft of companies that have reported today trade on the market.
James, how difficult is it to manage exposure given that we're in the midst of reporting season, individual companies are reporting, but we also have this geopolitical risk in the background that's causing huge swings, volatility, even for our local market?
Yeah, I guess it depends on time frame. So, we're not short-term traders, so we're more, active investors, we like to call ourselves. So, you've obviously got to be in the right sectors at the right time. So being in things like energy, when energy prices are storming higher, is a great place to be. But if you think about, do I go and buy that now? I'd probably say no, the risk reward is gone. So, I'm trying to look 6 months ahead and seeing what the market is doing in 6 months' time, not what the geopolitical news flow is going to be in the next 24 hours, because simply I don't have an edge in that space. So we're all about positioning portfolios for the months ahead, not the hours ahead. So I think if you have that context, it makes it a little bit easier, Cara.